It's time for charting futures. Let's get to Taylor Riggs.
Thanks, Caroline. And joining me is John Kolovos, Chief Technical Strategist at Macro Risk Advisors. And John, we were talking equity markets are higher today, but you would describe yourself as a bit cautious. And I know your latest chart, really looking at the Nasdaq 100, shows us that. Here it is. Walk me through the technicals.
Absolutely, yeah, and thank you for having me. So here's a chart of the Nasdaq 100 going back to the beginning of this year. I believe that equities in general right now are going through a corrective process. And what do I mean by that is, I always tell clients that corrections happen in 3 phases, or 3 acts, or a 3-act drama. Act 1 is the first leg low, then there's a reaction higher, which would be Act 2, and then the 3rd act would be the final movement lower. Corrections tend to be shorter term in duration and also in magnitude. So I think the risk here for the Nasdaq 100 is a move down to 7,000. How do I get to 7,000? Is that the distance from Act 3 tends to equal the distance of Act 1. So I think the risk right now for the Nasdaq 100 is down to around 7,000, so long as it stays below that 7,800.
Yeah, very, very interesting. Now we're also looking at the second chart on my terminal here, where you tie in the rates market. How does that fold into also your calls here?
Yeah, so I think the interest rate environment holds the key to the equity, for equities to stabilize here. And what we see here on the top click is the ratio of copper to gold. And on the bottom is actually the 10-year interest rate here in the US. And you notice that they ebb and flow together. And when I look at these 2 charts from a technical perspective and from a trend perspective, I really don't see much of a stabilization or anything to say that it's oversold and should bounce, but the trend is pointing to lower interest rates.
Well, and it really looks on those log charts, that curvature certainly is something that gets my attention. You're also taking a look at your third and final chart, which is really breaking out copper and gold separately. To me, this looks like head and shoulders, but what do you call it?
It is head and shoulders. Some people look at the clouds and see turtles. I tend to see head and shoulders tops, and I think copper, when you just deconstruct the ratio, you actually see a head and shoulders top forming for copper. If it would have a sustained breakdown, it could get down to about 200 or so. That would send shivers down, I would say, the macro spine here. But on the other end, when you look at gold broke out of a very large base formation, which would imply a move somewhere around 1,800 or so. So when I combine these 2 together, I can envision a lower copper-gold ratio, lower interest rates, and still a shaky environment for stocks.